The IRS has officially dropped the new tax brackets for 2024. All 7 tax brackets receive major taxable income increases due to inflation. This saves all of us money on federal taxes, and it's also beneficial for capital gains and qualified dividends. I've always enjoyed learning the ins and outs of the US tax system. I'm not sure why, and something is likely wrong with me. But the good news for you is I'm here to save you time and money on your taxes in 2024. In this video, I'm going to quickly review the new 2024 tax tables, and I'm also going to attempt to explain how our tax system's actually a lot more simple than you may think. Believe it or not, you don't need an accounting degree to understand over 95% of our tax system. And putting together a solid game plan early in the year for your taxes will save you money compared to blindly throwing it all at your accountant at the last second and saying good luck. If you're new to the channel, welcome. My name is Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please smash that like button, subscribe, and let's go. The U.S. progressive tax system. The U.S. has a progressive tax system. This means that every taxpayer will pay the same tax rate in the same tax bracket as everyone else. This is the most misunderstood aspect of our tax system in the United States. I have had so many people come up and tell me that they got screwed by earning a little extra money that pushed them into the next tax bracket. They believe that all of their income will be taxed at their marginal tax rate, which is the top bracket that their last dollar falls in. The truth is you only pay the extra taxes on the few dollars that pushed you into that tax bracket. Everything else below is paid the exact same rate as everyone else in that bracket. A person that makes $750,000 per year will be taxed on their first $40,000 the exact same that a person that makes $40,000 for the entire year is taxed on that $40,000. It's incremental. Every taxpayer benefits from the lower tax rates of each bracket regardless of their income. The IRS adjusts the income thresholds of each tax bracket on a yearly basis to avoid bracket creep. And bracket creep is just when a person gets pushed into another tax level just because of inflation. 2024 tax tables. The IRS increased the income limits of each tax bracket by about 5.4%. in 2024. This is a respectable increase to help us fight against the red-hot inflation that we've been battling over the last couple years. Let's hop over to my screen real quick to check out the new limit for each of the 7 tax brackets. We have single filers on top here, and married filing jointly is down here. So just working up the single filers, you'll see here in column E, this is the percent change. They all went up by about that 5.4%, like every tax bracket went up by that amount. So there are 7 tax brackets. There's the 10, 12, 22, 24, 32, 35, and 37% tax bracket. So the 2023 limits for each bracket are listed here, and the 2024 limits you can see went up by a sizable amount. This is a big bracket here, this 47,000 for single or 94,000 for married filing jointly, because if you keep your income under this, your qualified dividends and long-term capital gains are taxed at 0%. So this is the 2024 tax bracket for single filers. You can see in this taxes owed column, everyone's first $11,600 is taxed at 10%. So that would be $1,160 of taxes. And then when everyone moves into the next bracket, the 12% bracket, their income up to $47,150 is taxed at 12%. And then when you move to the next bracket, up to $100,000 is taxed at 22%. So you take what's already been taxed here, again, the same for everyone, carries down to the next bracket. So the money you make over $47,000 but under $100,000 is taxed at 22%. And you go down the line for each tax bracket. So that person that makes $1 million a year and is paying 37% taxes on all their money over $609,000 paid the exact same taxes in each tier of the way as someone that had $191,000 did to this point. So again, we have a progressive or incremental tax system, and there are 7 total brackets. 2024 capital gains and qualified dividends. Capital gains and qualified dividends have a special tax table that's taxed at a favorable rate compared to your ordinary income. A capital gain tax is the tax on the profit from the sale of an asset. This includes investments such as stocks, bonds, cryptocurrencies, real estate, cars, or your boat. There are long-term capital gains and short-term capital gains. You must have a long-term capital gain to benefit from the favorable tax rates. Long-term capital gains apply when you held the asset for at least 1 year before flipping it for a profit. Short-term capital gains apply if you sold the asset for a profit before you held it for at least a year. Short-term capital gains are taxed at your marginal tax rate, so it's taxed as if it's ordinary income. If the value of your asset has increased over time, be sure to make sure you held it for at least a year if possible before you sell it. Your long-term capital gains, as well as any qualified dividends you receive from your stocks or ETFs, will be taxed at 0, 15, or 20%, depending on your taxable income. Here is the capital gains tax table for 2024. This is the 2024 long-term capital gains tax rates and brackets. So again, these rates will apply to long-term capital gains and qualified dividends. Short-term capital gains, as the chart says here, are taxed as ordinary income. So they are taxed according to the regular federal tax brackets that we looked at earlier. This special tax table is only for long-term capital gains and qualified dividends. So as you can see, you'll pay 0% tax on long-term capital gains if you're single, up to $47,000 of taxable income. If you're married, you get up to $94,000 of taxable income to pay 0% taxes. Now you'll pay 15% taxes on long-term capital gains and qualified dividends for up to $518,000 if you're single and $583,000 if you're married. And if you make a ton of money, it's still only 20%, which is a lot more favorable than that 37% that you're used to on anything above these amounts. So long-term capital gains and qualified dividends will save you a lot of money on taxes regardless of where you fall with your marginal tax rate. Long-term capital gains and qualified dividends will not push you to a higher federal income tax bracket. They are considered after and separately from your ordinary income that is used to establish your marginal tax rate. Your taxable income will be set and you'll know exactly how much ordinary income you brought in to establish that. And then your qualified dividends and capital gains will be considered at the very end. However, you can be in the situation where some of your long-term capital gains or qualified dividends are taxed at 0%, and then some of them are taxed at 15%. For example, let's say you're married filing jointly, and you go to file your taxes for 2024, so April of 25, you're filing for 2024 taxes with a taxable income of $85,000. So you fell in the 12% bracket. 12% is your marginal tax rate. Let's say in 2024, you also sold a stock that you had held for 2.5 years for $15,000 of profit. So that gives you a long-term capital gain of $15,000. In this case, the first $9,050 of capital gains would be taxed at 0%. But then at that point, your $85,000 of your ordinary income that stuck you in that 12% bracket, plus that $9,050, when you add those together, you reach the threshold on the special tax table for capital gains that goes from 0 to 15%. So the last $5,950 of capital gains would be taxed at the 15%. Again, this does not change anything to do with your regular tax return, your ordinary income, and your marginal tax bracket rate. This is strictly tacked on at the end. I can't emphasize that enough. A lot of people worry that having too many long-term capital gains or qualified dividends in a single year is going to screw up their marginal tax rate. Now, short-term capital gains from the assets that you didn't hold for a full year and then you sold for a profit will count as ordinary income. So short-term capital gains can, in fact, push you to a higher tax bracket. The general rule of thumb is to always hold on to that asset, if possible, for at least a year before moving it, assuming you have gains on it. Another important tax tip for homeowners is that you can exclude up to $250,000 of capital gains if you're filing single, or up to $500,000 of capital gains if you're married filing jointly when you sell your house. You must have lived in the house for at least the last 2 years as your primary residence, and you also must have not used this exclusion within the last 2 years on a different home that you sold. As long as you meet those two criteria, you're good to go to save yourself, for married folks, $500,000 of capital gains that would have been taxed. You can also offset capital gains with capital losses. So for example, if you sold a stock for a $6,000 gain and you sold another stock for a $3,000 loss, you can net those against each other to only have a $3,000 gain that you owe taxes on instead of the $6,000. Short-term gains will first net against short-term losses, and long-term gains will first net against long-term losses, and then the excess of both can be netted against one another. You're also allowed to use up to $3,000 worth of capital losses each year to offset your ordinary income. If you have losses in excess of $3,000, you can only apply $3,000 per year against your ordinary income, but you can carry it over indefinitely to use it for future years. This was a lot of really nerdy information to cover. Thanks if you stuck it out this long. And since you're here, check out one of these 2 videos if you don't already have a big enough headache from this one. Thank you for watching, and I will see you here next Thursday, and sometimes on a Sunday. Peace.